While the global markets reel from the latest PPI inflation shock, a silent phenomenon is occurring within the digital asset landscape. It is May 2026, and a massive capital migration has begun. Data from DefiLlama reveals a startling reality. Binance has captured a staggering 78% of all centralized exchange net inflows over the last 30 days. This isn't just a standard fluctuation, it is a deliberate, coordinated parking of global liquidity. While Bitcoin's price action remains suppressed by institutional ETF outflows, the internal pipes of the crypto economy are swelling with massive amounts of stablecoin reserves. We are witnessing the birth of the largest dry powder reserve in the broader market is currently paralyzed by fear, as the PPI data suggests a hawkish Federal Reserve. Yet the smart money is moving in the opposite direction. Why are stablecoins flooding into Binance specifically, despite the macroeconomic panic? The answer lies in the capital siphon effect. This is the strategic consolidation of purchasing power into the world's deepest liquidity pool. By parking capital in USDT and USDC on a central hub, large-scale traders are positioning themselves for immediate execution. They are not exiting the market, they are retreating into the trenches and sharpening their bayonets. This accumulation phase is often invisible to the average retailer. Look closely at the exchange balances. The sheer volume of stablecoins sitting on Binance is now exceeding levels seen during the height of the 2024 bull run. This indicates a massive holding pattern. When capital enters an exchange but does not immediately buy assets, it creates an incredibly pressurized environment. This silent rally is a rally in purchasing power, not yet reflected in the price charts. We are seeing billions of dollars in dormant capital waiting for the macro environment to stabilize just enough to provide a clear green light. The geometric logo of the exchange has become a magnet, pulling in liquidity from every corner of the globe, including secondary exchanges that are seeing their reserves bleed into the dominant market leader. The disconnect between institutional spot ETF flows and exchange-native liquidity is reaching an all-time high. For weeks, the headlines have been dominated by massive outflows from Bitcoin ETFs, leading many to believe the bull market is over. However, this is a dangerous half-truth. While institutional paper money is exiting through regulated channels, the on-chain whales and retail power users are aggressively accumulating. For every dollar leaving an ETF, nearly 80 cents is being funneled directly into Binance's stablecoin vaults. This bifurcation suggests a massive transfer of ownership from passive institutional holders back to active crypto-native traders. It is a classic distribution phase where the weak hands. To understand the gravity of this situation, we must look at the on-chain evidence of whale accumulation. Large-scale wallets, those holding over $10 million, are not sending their assets to cold storage. Instead, they are moving liquidity onto Binance in the form of stablecoins. This behavior contradicts every mainstream bearish narrative. Typically, when whales expect a crash, they move funds to secure wallets or exit to fiat entirely. Moving to an exchange signifies a readiness to trade. This is the ready, fire stance. They are waiting for the volatility spike to settle so they can deploy their capital into undervalued altcoins with surgical precision, leaving the panicking retail sellers in. Retail sentiment is currently in the extreme fear zone, yet this is exactly where the siphon thrives. While the average trader is distracted by the volatility of Bitcoin and the threat of rising interest rates, the Binance ecosystem is absorbing the very liquidity these traders are forfeiting. It is a psychological trap of epic proportions. The silent rally relies on the fact that most people wait for the price to go up before they buy. However, the smart money knows that the true rally begins when the dry powder is at its peak. By the time you see the green candles on the daily chart, the capital rotation has already happened, and you are simply providing the necessary exit liquidity.
This is institutional shadowboxing at its finest. By using centralized exchanges like Binance to park capital, rather than holding it in public-facing ETF products, large entities can move with much higher levels of obfuscation. They are utilizing the massive liquidity depth to avoid price slippage during the eventual pivot.
This strategy allows them to accumulate massive positions in top-tier altcoins without alerting the broader market until the move is already underway. This hidden hand approach ensures that when the capital rotation finally hits the Layer 1 networks, the movement is explosive and parabolic. They are not just buying the dip, they are engineering the next phase of the entire crypto market.
History provides a clear roadmap for what happens next. Looking back at late 2020 and mid-2023, we see identical patterns where stablecoin reserves on exchanges hit record highs, while Bitcoin traded sideways or downward. In each instance, this massive buildup of dry powder preceded a parabolic run in the top 10 altcoins. When the ratio of stablecoins to exchange market cap reaches these extreme levels, a supply shock becomes inevitable. Once the buying pressure starts, there is simply not enough sell-side liquidity to satisfy the demand of billions of dollars being deployed at once. We are currently sitting on a powder keg that is significantly larger than any we have seen in previous cycles. The concept of altcoin gravity explains why this capital won't stay in stablecoins forever. As soon as the first major Layer 1 network shows signs of a breakout, the parked capital on Binance will act like a vacuum, pulling in more liquidity and driving prices higher. This wealth effect starts at the top and trickles down. First, the large cap assets like Ethereum and Solana will absorb the initial wave of the siphon. Then, as profits are realized, that capital rotates into high beta mid-caps. This is the waterfall of liquidity that every seasoned crypto trader dreams of catching. The siphon has effectively compressed the spring, and the release will likely be the most aggressive rotation we have ever witnessed. This massive accumulation also creates a unique liquidity wall. Because so much capital is parked and ready to buy, any minor price dip is instantly swallowed by buy orders, creating a high floor for the market. This is why we are seeing such resilient support levels despite the macro headwinds. The Binance Capital Siphon has created a safety net that the mainstream media hasn't even noticed yet. They are focused on the ETF outflows, but they are missing the fact that the floor is being reinforced with billions of dollars in stablecoin buy walls. When the macro pressure finally eases, this wall becomes a launch pad, propelling the market into a new price discovery phase with incredible velocity. How do you track this in real time to ensure you aren't left behind? You must monitor 3 specific on-chain metrics: the net inflow of stablecoins to Binance, the stablecoin supply ratio, and the exchange whale ratio. When you see a sudden spike in the stablecoin supply ratio alongside a decrease in exchange-held Bitcoin, you are looking at the exact moment the rotation begins. This is the green light signal. Tracking these exchange movements allow you to front-run the retail crowd who won't realize the trend has changed until it appears on their newsfeed. The data is transparent and available. You just need to know which pipelines to watch to see the money moving. As we approach the final pivot, the data is undeniable. The Binance Capital Siphon is not a temporary anomaly. It is the fundamental precursor to the next massive rotation into Layer 1 networks and the broader altcoin market. To win in this environment, you must stop looking at the price ticker and start looking at the liquidity flows. When those tens of billions of parked stablecoins finally move, the slippage will be minimal for the whales, but the price appreciation for the rest of the market will be vertical. Keep your eyes on the net inflow charts and the stablecoin dominance ratios. The vault is full, the fuse is lit, and the only question remaining is, are you positioned or just watching?